Good afternoon, ladies and gentlemen, and welcome to GLANTUS HOLDINGS PLC Interim Results Investor Presentation. We do apologise for the late starting of today's meeting. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged. You can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Simply click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question it receives during the meeting itself, but the company review all questions submitted today and will publish responses where it's appropriate to do so. These will be available via your investor dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Maurice Healy, CEO, and Granny McEwen, CFO of GLANTUS Holdings PLC. Good afternoon.
Good afternoon. Thank you, everybody, for attending our webinar for our maiden interim results. As some of you may be already shareholders of GLANTUS and some may not. We listed on AIM in May 2021, so not a huge length of time ago, but we're delighted to publish our first interim results as of the 30th of June. Our financial year is from January to December, so calendar year. So without further ado, I'm just going to kick off with a couple of the financials. You may already have received the RNS interim report, the more detailed report, and also a more graphic version of that interim report is available on our website as well. So I encourage everybody to read that, and by all means contact us with any questions or clarification required. So just a few slides on the financials to give some high-level overview. By way of background, actually, I'll just hand over to Maurice Healy, our CEO, who's going to just give a very quick background introduction of who GLANTUS are. Some of you may be new to GLANTUS and our story, so I'm going to give Maurice the floor for a couple of minutes to give a bit of background on our history and what we do.
Thanks, Grania. I think I am the reason for the delay in starting. I'm in the States at the moment, and there was some trouble with the VPN, so apologies for the delay. I won't keep you long because we get into the numbers. We'll run through the numbers. As Grania said, it's only been covers a 6-week period from the IPO to the interims, and then we focus quite a bit on what has happened since the end of period. Just a quick reminder to everybody, we work in the accounts payable market for large organizations. We define accounts payable as any company with a spend greater than $500 million and with the number of suppliers at greater than 4,000 up to north of 120,000. We have developed products, our own products. It's all our own IP, and the fundamental thing we do with these large organizations is we recover lost credits through duplicate payments or credit notes not processed correctly. We have an immediate ROI for our customers, and that we find lost working capital. That's the market we operate in, and that's the market we explained as we were going to the IPO. I do a little bit more on that as we go forward, but I'll hand back to Grania to take you through the numbers.
Great. Thank you, Maurice. Okay, so just a few slides here. As I said, obviously they're in a lot more detail in the interim report, and I am available for any questions if there is any further detailed questions. At a very quick snapshot, our key metrics are half year to half year comparative results. Revenue was up, adjusted EBITDA up significantly. Our debt is down, and our net cash, we've turned net cash positive. Obviously, IPOing in May of this year has helped us on that journey, but also as a result of significant cost savings made in the business and reducing our debt. So the next slide then just shows this in just a little bit more detail, and you can see the trends H1 2020 to H2 2020 to H1 2021. Revenue, as you can see, climbing, and a extremely healthy recurring revenue at 89% of total revenue. And of the recurring revenue, our subscription churn rate remains extremely low at 4%, which really demonstrates our customer retention rates and how sticky our product is with our customers. The adjusted EBITDA, fantastic work done by everybody over the last year. The results that you see here are comparative like for like. We did the acquisition of JPD in January 2020, so it's all organic. And you can see the jump in the adjusted EBITDA is as a direct result, not just of acquisition synergies, which Maurice will go into our acquisition strategy later on, but you know, it wasn't just a case of merging departments together and making savings, although we did obviously do that. But we also, most importantly, transformed the business that we acquired and made it more automated and more efficient, which drives the EBITDA line item up. The debt has come down from 8.4 million down to 7.2 as of June 2021. And then you can see we've turned net cash positive. Cash reserves obviously been very healthy, and as a result of the IPO proceeds. So the next slide then goes through the income statement, and just calling out some of the key items here. Revenues, you can see just under 4.3 million, up from 4 in H1 2020. Cost of sales are down again, as I said, from direct labor costs have reduced as we drove that efficiency of the delivery of the product. So gross margins went up to 80%. Administrative expenses are down again, efficiencies, cost control, all put in place to drive that adjusted EBITDA up to just under 1.2 million. So adjusted EBITDA percentage of 28%, extremely robust. Other items just to call out there, the exceptional items, that's all IPO costs, and so the AIM admission costs and legal and professional fees resulting from that. And if some of you are familiar with our admission document, one of the conditions of our funders was the exit fee was split into two, and part of that was triggered at IPO, known as an IPO sale trigger fee, and that was €1 million that was paid to the funder. So all of that flows down through our adjusted earnings per share, going from 2 cents in H1 2020 to 4 cents in 2021. Then just a quick look at our cash flow. Obviously, cash at the end of the slide there, you'll see our cash just under 8.8 million. And key items to pull out there is obviously still generating cash. This also includes payment of deferred consideration, which would have been a set timed payment for a JPD deferred consideration. And then the other item there is our R&D. We continue to invest in our R&D and product development. Maurice will explain where we're positioning our products going forward. The IPO exceptional cost there, as I called out on the previous slide, the equity proceeds of 11.6 million coming in, and then a further equity IPO cost against the share premium of 937. So all in, very happy with our performance for the H1 2021. And now I'm going to hand you over to Maurice, and he's going to explain the business as we are today. And obviously, June seems a long time ago, and a lot has happened in GLANTUS life in a matter of weeks. And Maurice is now going to explain what we've been doing since the end of that H1. Maurice.
Thanks, Ronja. First of all, I guess looking back at the time of the IPO, we raised the money and we were looking at 3 growth areas: organic growth, growth through partnerships, and acquisitions. And I'll touch on all of these as we go forward. The first one is that obviously since the end of the period covered by the interims, in July we acquired a company called Technology Insight Corp. TIC is based out of Boston, a place called Marlborough, which is about 45 minutes west of Boston. That's where I am right now. If any of you ever get a chance to visit Marlborough, don't. it's not the most exciting place in the world. But Technology Insights was a company that turned over 4 million, 2.5 million in subscription revenue, and 1.4 million in recurring transactional revenue. They've been working in the industry for over 20 years. They developed their products through customer demand, a bit like we did ourselves. And though their technology wouldn't be as good as our technology on the GLANTUS platform, their know-how was really important and accelerated our ability to design the products, improve the features in our own product suite by their experience. The customer base now, we combined, gives us a customer base of 90 consolidated enterprise. We have a bigger customer base than that, but these are the large organizations that is really the focus of the business as we go forward, as I said, with an average spend greater than $500 million. Moving on, just to give you a bit on the consideration, we paid 9 million for it. That represents 2.25 times revenue. The adjusted EBITDA for the company was 1 million, which would say 9 times EBITDA we paid. But again, our synergies will be north of 500. So at 500, it's about 6 times the EBITDA. The integration of the business has gone really well. We have made the cost savings. We are also investing in the combined business. The integration has gone really well. There were a lot of reasons for buying TIC apart from the numbers. We now have technology base in the US. We've grown our market share in the US. We've enhanced our brand in the US. And we have just a lot of new talent from doing that acquisition. Just going on to the growth strategy and the product portfolio. When we were doing this and talking at the time of the IPO, we were talking about the GLANTUS platform delivering these services. But post TIC, we've now consolidated all of our capabilities into these 4 products. We're using the Shark, which we got from the TIC acquisition as the kind of addendum to the name. They had established Data Shark, and we're working through our products. The reason we have done this is that it makes it much easier for our salespeople going into the organization saying DupliShark, that's the duplicate product, DocuShark, the automation, Statement Shark is their reconciling. And Recovery Shark is the traditional transactional recurring revenue, which we deliver through our 3 products. The approach, so this is slightly different to what you'd have seen in June or in May. It's just part of the evolution of the business. Makes it easier for customers, makes it easier for our salespeople and even our investors to understand precisely what we're selling into these organizations. And it has gone really well. We launched this approach for the first time in Florida last week. There was an event in Florida. We didn't have the biggest stand at this event, but we were the busiest by far there. The bright orange stood out among all the purples and blues of our competitors. We had just our screens with all our analytics appearing on it. We got about 50 leads from that, and normally I'd be skeptical about leads from those things, but 15 have already transformed into meetings as we go forward. So we're really onto something organically in how we're going. And as you look forward there to the organic growth, that's how the new logos are coming. These events are important. We're building up our pipeline from these events, and it's really strong. But the combination of these products as well, when we take the TIC customer base and our own existing customer base together, we now are structured our sales in the States. We structured it by region, the East, the Center, and the West. And we've got a new salesperson, an account manager, and a lead generator in each of those regions. And the account management side of things is actually just dealing with the demand from existing customers. So our customers, we're implementing the DupliShark, the duplicate payments in, and the TIC customers, we're implementing Statement Shark, and a lot of them now getting the combination of both as we go forward into the new logos. So really strong organic growth, really strong response post the TIC acquisition. It's been great. So that principles about how we're going forward. I'm not going to spend too long on this, but that assessment report there in the opening line on winning principles, I'm assuming, Grania, you're moving these along because I can't see, but the assessment report is really interesting because we've developed a bit of software that we give to the clients that enables them to download all the data we need. We then get that data and we run it through our products and we give them an assessment report. And the assessment report says, you know, we've discovered 30 duplicate payments, we've discovered lost credits of so much, and it also gives other insights to them under the analytics. We'd say we've identified 5 reasons, 5 points in a 10-point scale why you should be concerned about your suppliers. It could be fraud, it could be other areas, and we highlight those. And it's been a real eye-opener for us as we go forward with this. Once we get them to take the assessment report, over 90% of them convert into subscription sales. So again, we're driving forward with this. It's really positive. And then moving on to the other 2 areas, the partnerships, we'll be making announcements around this. That's going really well. We're fine-tuning the type of partners we want. We won't see revenues from this year, but we'll see it next year. And there are a couple of announcements that hopefully we'll be making in that space over the next while. And then finally,
Maurice, sorry to interrupt you there. Might as well just approach it here. There is a question in from Chris Orr on how we implement and grow the partner strategy. So if you might just want to expand on the partnership a little bit more there.
Yeah, sure. So we have a program of different classes of partnerships. Most of the partners, so first of all, in qualifying partners, they have to be working already with our type of customer. So generally with the finance departments of large organizations, typically they are giving a much narrower service into those companies. So it might be that they're just looking at tax issues, recovery on tax or recovery on utilities, and they need to expand their offering into the customers. And we've got the products that complements what they're doing, and so we're perfect to begin. And then from the implementation point of view, we tend to start with them as a referral partner. So we'll go in alongside them to the customer. And then as we build up a bit of traction, we train their staff up to do implementations and to work with the product and to work the sales end of it. So we take them on a journey from pure referral, where we work alongside them and share the revenues, and then we help them build up their resources internally to be able to do it as a full partnership. I hope that covers that question. So I'll move on to the acquisitions then. So again, this is a big part of our strategy. We are, we run our business tightly. We watch our margins. We look at our growth on EBITDA. But we're also very conscious, and a big focus for us is the fact that we believe there's a huge arbitrage in what we can acquire companies for and what our ultimate exit multiple will be. In the States at the moment, in our space, the multiples of revenue are 5 to 10 times depending on the scale. When you hit $20 million run rate, you're at 5 times. When you hit $50 million run rate, you're up at 7 to 10 times. And that's how it operates here when you have your own product and you're selling your own IP. And that's exactly what we're doing. So we're looking at acquisitions that fit directly into acquisitions like TIC. like JPD last year, where we can take those organizations, we can take that customer base. First of all, from a cost perspective, we apply our own technology to their processes and procedures, and we eliminate a lot of costs. In the case of JPD last year, we took it from 65 people down to 35 people, providing an enhanced service. With TIC, we have started off, we've identified 500,000 in just people, but that will continue over a period, and we'll continue to drive costs out of that. So that's the first part, and how we enhance the EBITDA and the margin. But then the second part is that all these clients are hungry for a solution that's on their desk. They don't want to be outsourcing their homework, as one guy put it to me, somebody looking for their mistakes and telling them where they're going wrong. They wanted to bring it in-house. They want the technology so that they can say they're in control. And that's what we provide. So we've great upselling opportunities with every acquisition. We drive the synergies down. And more than that, as we reach that scale, our multiples and valuation grow. We have a pipeline of activities, acquisitions on the go at the moment. We're working our way through them, both in EMEA and in the US. Some of them are small, some of them are larger than ourselves, and we'll continue to do that and to work through those. This is our third presentation since when you take the IPO, we were doing roadshows. We did it at TIC. We're now doing it at the interims. The next calendar date for an update would be next March for the full year results. But believe me, we'll be having other events like this, because we have a lot of activity in the pipeline that will require us to come on. So we have very strong organic, the partnerships working, the acquisitions, a really strong pipeline. So in summary, we've looking at the outlook, we've done everything so far that we said we would do. I think as a team, we are probably more confident and more excited about what's in front of us than we were even at the time of the IPO. Everything we had assumed has come to pass on all three of our growth areas. We're not without our challenges. We're still out there. These are competitive markets. People, we still need to grow our people side of things. We watch COVID very carefully. COVID was good at a holistic level, but every now and again, some alerts might come out, and you'll see some customers stall things while they assess what's going on with COVID. But so far, it hasn't had any major negative impact on us, and it's been more positive than negative, but it's something we keep an eye on. Our strategy is working, and we're in a good place. So from our point of view, it's about keeping the head down now and getting on with it. And that's me done. Is there any questions, or I don't know how this happens?
Yeah, no, Maurice, thank you so much indeed for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the team take a few moments to review those investor questions submitted already, I'd like to remind you that the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the team, and immediately after the presentation has ended, you will be redirected for the opportunity to provide your feedback so they can better understand your views and expectations. Granny, if I may just hand back over to you, just to click on that Q&A tab, and where appropriate to do so, if you could just read out the question and either give your response or direct it to Maurice, that'd be fantastic.
No problem. Thanks so much. No problem. I'll address the second part of that question that was about the partner strategy. So the question was, how do you implement and grow your partner strategy, and can you explain a little bit more about the revenue split between SaaS and the transactional revenue? So we've hopefully answered the first part of the partnership strategy. Our split between the SaaS and the transactional revenue has changed since we've acquired TIC. As you probably saw from the slides earlier, there's about $2.5 million of subscription revenue with the TIC and about 1.4 of transactional revenue. So that has changed our mix. It has moved our split up, that it is more 50-50 between subscription revenue and recurring transactional revenue. The transactional revenue still is very strong and repeatable and consistent with the same amount of customers month in, month out from that respect. So hopefully that has answered that question. And as we go forward with future acquisitions and with our focus on our product strategy, as Maurice has outlined, the 4 products in the previous slide, we will be focusing on the subscription SaaS style revenue going forward. And again, giving that customer that control element. The other question then is, who do you compete with and where do you differ to win new clients? So I might throw that over to Maurice.
Yeah, no problem. So we compete with, there are a lot of companies in this area. So the gorillas in the States would be the likes of PRGX, Apex. PEX is another competitor we have over here. And then there are a lot of companies, you know, mid-sized companies in that space. So in Europe and in EMEA, you've got companies like Transparent, Meridian, companies like that. Again, we're probably bigger than a lot of them at this stage as we continue to grow. And 2 things I'll say about the competition. How we compete is that we have a unique collection of products. So the products I showed you there is pretty unique in the industry. The combination of the recovery and the automation. Sometimes I feel it's like an industry that technology forgot. What all of these organizations have, they're still very manual, process-driven, and they haven't allowed or invested enough in the technology. And that's creating opportunities for us, as I said with them. The second thing is that the collection of products is unique to us, and that's a big USP. But individually, because we often will start off with a duplication, we'd start off with a Statement Shark, or it might be an automation piece. So we have invested in making sure that each individual product is also best of breed. We continue to look at the features of other products in it, and we're making sure at all stages that the development team is focused, making sure that we have the best and most effective features in each of our products. So that's the first thing. That's how we compete with them. And it's, I won't say that it's not easy, but as I said, it's been a kind of a sleepy industry. So we are disruptors in the industry in how we apply our technology, and that's been a big plus for us, as we've seen last week in Florida. The other part of that, though, is that within all of that competition that we talk about, whether it's in EMEA or in the States, that's also our target list for acquisitions. So we're getting quite close as the brand has developed, as our name has developed within the industry. We are now, it's much easier for us to approach some of these competitors. They know who we are. We have a good reputation in terms of how we go about acquisitions. And so that enhances our acquisition pipeline as well. Kind of a long-winded answer, but that's it.
Okay, next question is outline the TIC deal financing and how do you intend to finance future acquisitions? So I'll take the TIC to start with. The purchase price was 9.3 million. We part funded it by debt. We made a decision that we could access financing with our current funders, Beach Point Capital, and we could access that financing quite quickly. They have a very good turnaround time. They worked with us very quickly. We wanted to get this acquisition done quickly. We knew we could. We didn't want it protracted. So we financed it with 5 million of 5 million euros of debt, and then the balance with cash. The payment on consideration was $6.9 million on consideration, 1 million in shares in GLANTUS, and then 1.4 million of deferred consideration, which is payable over the next 18 months or so. To finance our future acquisitions, it's going to depend on the deal. As Maurice said, we constantly have a pipeline of acquisitions we're looking at. We would be confident of picking up some deals over the next while, acquisitions over the next while, which may be smaller in nature, and we can finance those by using our own reserves. But if we're looking at a much bigger acquisition, we're going to be looking at maybe a combination of debt and equity, and we will visit that depending on the deal and what comes down the tracks from that respect. We also did say back at the IPO stage we were going to look at refinancing our existing debt. So all of that is part of the strategy and the roadmap to work out the refinancing needs depending on the deals that are in front of us. The next question.
Thanks, Grania. And if I just add to that, Grania, that
Yes,
at the time of the deal, we had lots of offers. The board, ourselves, and Arden took a good hard look at that refinancing. And whilst we had situations where we could have refinanced the whole lot and probably a bit lower than what we wanted, it would have tied us in for what we'd be doing, for what we want to do going forward. We do expect some larger deals to come on. We needed the flexibility to get the perfect combination of debt and equity as we go forward. And so we decided to stick with what we had because that gave us the maximum flexibility at the lowest cost at that time. So we did take a good hard look at it, and we will, of course, as Grania said, be doing a refi, but it'll be on the back of something large, and it'll be at terms that absolutely suit us. Sorry, Grania.
No, thank you, Maurice. And then the final question is, are M&A deals competitive and unrealistic on price? What are the key metrics you really look for to enhance the group?
Yeah, it's at the moment, it can be competitive. There's no question. One of our partners that we've been on shortly, where we were looking at they're an acquisitive company themselves, and I was going through the metrics of TIC when we had done the deal with them. And in their industry, a similar deal was costing, they bid 16 million on almost an identical deal to what we did TIC at, and they only finished third in the reckoning. So it can be competitive. We have a little bit of an advantage in our industry. First of all, there aren't a lot of aggressive, dynamic companies in the sector that we're competing with at the moment. So there aren't a lot of companies chasing down what we're chasing down right now. That's number one. The second bit is that a lot of the companies we're looking at are still sleepy and process driven. So they're not immediately attractive because they don't have huge technologies with huge subscription revenues. We convert them into that when we get it. They've got the customer base, but they're applying it in as I said, a lot of manual and service driven way. So we're able to get again buy them at a decent multiple because they're more attractive to us than to most. And then finally, and this will not always be the case, but we are getting companies subscale. Even TIC at 4 million turnover, it doesn't attract the higher multiples. Now we are going after bigger companies, and so they would attract a higher multiple. But because again, a lot of them are so manual and so service driven, we're able to dampen that expectation down a bit. So we're continuing to look at companies with a 5 to 7 EBITDA or 2 to 2.5 times revenue. We still have those in our pipeline, but as we start to go up in size, that will become a bit of a challenge, but still well within the arbitrage range. So far so good on that front, but we are aware that as we go for bigger companies, we'll have to fight a little harder.
Maurice, Grania, thank you very much. You have covered all the questions that we've had through so far. And of course, if any further questions do come through, the team will have the ability to respond to those. And we'll publish those responses where appropriate to do so. Maurice, perhaps before we redirect the attendees to give you some feedback, if I could have a few closing comments for GLANTUS in the next 6 months, please.
Thank you. I guess I'm only going to repeat what I said already. It seems when we're working in the business, the IPO seems to have been ages ago, and we have to remind ourselves it's only 4 or 5 months ago. And because things change fast in our business with our growth, the talent we have in the business has grown as we've moved forward. We've brought in some really super people into the organization, so the talent has grown. And as I said during the presentation, the opportunities that we saw last May, we are more confident and more excited about those opportunities as we go forward. So from my perspective and the company's perspective, everything we've said at the IPO is coming to pass, and the market is exactly how we felt it was. And we're going to be very, very busy people over the coming months and the coming 12 months, and we're excited about it, and we're very, very positive and optimistic about the future.
That's fantastic. Maurice Grenier, thanks again for updating investors today. Can I please ask investors not to close the session? You should be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few minutes to complete and is greatly valued by the company. On behalf of the management team of GLANTUS Holdings PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you very much and good afternoon.
Thank you very much, everybody.
Thank you.